Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go on social media, see what people are sharing. I'm going to share my financial opinions as we go, and we'll dive right in. It's going to be related to three topics: wealth building, commodities, and or financial topics. So let's dive in. Let's see what's going on and what people are talking about. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, that's where we talk about individual companies, individual sectors, and really good setups. We do have a training session coming up on Thursday. Check the website for the exact time. I'll post that up here. Okay, so Logan says recession doesn't equal housing crisis. Home price change last 6 recessions. And we've got two that pulled back, barely pulled back in 1991, which was a hyper supply phase of real estate, along with 1980 and 81, that was also a hyper supply of real estate. And these two, they were not hyper supplies of real estate. And 2008 was the great financial crisis. And that recession was caused, in my opinion, by the real estate market. So I know a lot of people think, oh, well, there's going to be a recession. It's going to bring down home prices. Not necessarily. That's not what history suggests. It is not what history suggests. The only time this is pulled back is when we had a housing-led recession in 91 and 2008. I don't think that's in the cards. I don't think we have a housing-led recession, and I'll get into the information and the data of why I don't think we're going to have a housing-led recession, if there is going to be a recession. Iron ore futures hit $140 a ton, the highest in 18 months. That is one area that we are taking advantage of on our website. We are invested in steel and iron ore, and both of those look very good, and they continue to move on up. What the rich don't want you to know. Pay yourself first, start a side hustle, eliminate bad debt, invest early and often, don't drive your wealth, buy assets, not liabilities, spend less than you earn, take advantage of the tax system. This is how you get ahead. What I will say is I basically do that to the T. I mean, that is literally me. I pay myself first. I started side hustles. I do not have any bad debt outside of the debt that the of my mortgage. I invest as much as I possibly can, which is literally paying myself first. That's really what it is. I drive crappier older cars, so I don't waste money on insurance, registration, or the car itself, paying for the car itself. I buy a lot of assets. That's all I buy. Assets, assets. I don't care about liabilities. I reduce my liabilities. And obviously, I spend way less than what I earn. And I do take advantage of whatever accounts give me tax advantages, Roth IRAs and stuff like that. The concept of active listings. Remember, only one group on X says there is no housing shortage, even though active listings per capita and on nominal terms are recorded at the lowest level ever. Prices have exploded, and they say prices will crash every year. None will show you their real names or forecasts for the past 10 years either. I want them all on a live debate to smoke them out. And that's all of the housing crash. We built too many homes. There's no shortage. Well, if there's no shortage, how do we have active listings exactly where we're at? Because they are talking out of their butt. How can you have home prices continue to go higher, even in the face of massive mortgage increase of rates? The only spots that went down in the market of the United States are those areas that have built too many homes and their inventories rocketed higher. And there's probably a few cities that have done that. but that was an overbuild scenario. We're not overbuilt, and that's why active listings are in no man's land, very, very low, all-time lows. Coming on down, the best playbooks for 20 baggers are deeply destroyed sector with 10 years plus time spent in the wilderness. The cycle implosive was so severe that research coverage is pretty much zero near the cycle bottom. Reversion to mean a certainty as demand achieves new highs. And that's what occurred in 2020 in oil. That was absolutely destroyed. Everybody said, no, oil is going to never go above $30 again. Kathy Wood. And all these other people basically said that. That's what the bottom looks like. It says the elapsed time has allowed 99.5% of investors to forget the sector and 97% of participants to change their business focus, consolidate, or go bankrupt. This is the easy buy and hold for reversion to mean. What sectors may achieve this in 24, 25? While multiple sectors will achieve 15 to 20-year lows in 24, few will have spent the required time in the wilderness to be forgotten. Uranium and deepwater drilling spent the time in the wilderness and, of course, have inherent repeatable cyclicality. Yeah, agreed. Millennials make more money than any other generation did at their age, but are way less wealthy per BI. What do you think that is? When I look at people, millennials that are roughly my age or a little bit younger, they just buy a lot of crap. I mean, that's really what it is. When I look back in 1999, or even in the mid 90s, half this crap didn't exist. Uh, we had what pagers came out in the 90s. So did cell phones like late 90s, mid to late 90s. And I don't think people, I mean, you didn't really have a cell phone. You didn't really buy a lot of these computers. I mean, there's a lot of stuff that just didn't exist that people didn't buy. And I think millennials probably think that they need to own all this crap. And they probably spend way more money than what most people did in the 70s, 80s, and 90s. So that's my guess. I think they just think that they should have all this junk and they probably buy a lot of crap. I don't know. That's my guess. And that's what I see with a lot of the younger individuals. Savings can be created by spending less. You can spend less if you desire less, and you will desire less if you care less about what others think of you. Yeah, pretty much. See, I have such a strong care for myself and such. I mean, I really don't care what people think of me in terms of what car I drive and stuff like that. I have great, how can I say this? I feel really great when I save money and invest it. That's probably where I get some of my greatest satisfaction because I'm investing in myself. And it's also a vote for freedom, future freedom for myself. So I value freedom to do what I want when I want more than having crap. And most crap, it's not going to make you happy anyway. You buy it, oh, it's great. And then it kind of fades over time for most people. Outside of very few things that I really like, I really just don't spend money on stuff. If I don't really need it, then I don't really buy it. And that's why I don't have a ton of furniture in this room. And some people make comments about like the lack of furniture. I just like I don't care. I um I'd rather invest the money and put it towards my future freedom and towards a more robust life for myself at an older age. What is more probable to happen next? Recession-driven further disinflation, deflation, or inflation resurgence due to supply chain disruptions and or central banks easing too early? Well, I don't think there's supply chain disruptions. Uh, I don't think that's a driver at all. I think that's all just an excuse. When you create 40% more M2 money supply in a very short time frame, that is what supply disruptions look like. They make it up and blame it on something else. But you've got so much money chasing so few of goods, of course you'll have a supply chain disruption. So, in my opinion, these surges of inflation is due to credit expanding faster than anything else. That's really what it is. It's liquidity or credit expansion. So it says you are here. What do you think is going to occur next? I mean, the fractal. What they're doing is they're comparing fractals and human behavior. So human behavior suggests that there's another wave to come of inflation, and that's what a lot of people are predicting. And what I'll say is, it doesn't matter who predicts it. Doesn't matter how many people predict it. People find comfort in numbers. This is going to occur. It might occur. It might not. I'm in the camp that it will occur based off of human psychology and cycles and where we're at in the expansionary phase of real estate. That's my take on it. But it doesn't matter who agrees with me or who doesn't agree. It's going to play out the way it's going to play out. And I know a lot of people say, well, no one agrees with you, or something like that. It doesn't matter if no one agrees with me. All that matters is that you're either right or you're wrong, and that's what I like about this game, a game of investing. You don't need consensus. You just need to be right, and that is trying to find the data, trying to find the human psychology, the patterns, the fractals, whatever it is, to get yourself on the right side of the trade, so to speak. Logan says home prices are at all-time highs. Inventory is near all-time lows. Days on the market are near all-time lows. New listing data has been trending at the lowest levels ever recorded in history for 3 years. Price cut percent are down year over year. For the S&P Case and Shiller, and we continue to go higher. These bubble people have been wrong, are wrong, and continue to be wrong. That's what I'll say. And this is Logan. The number of homes on market is meaningless without more context. If the listings are out of reach of the majority of buyers, you can have 5 listings in the whole market and still see this. Oh my God. I'm sorry. This, as long as prices continue to move up and sales continue to move up, and you have low listings, what this guy is saying, I disagree with it. That's like saying you have a major shortage of oil that everybody needs or wants, but the price could go down. It's like, the fact that you have a shortage is the problem. You don't have enough of whatever. Homelessness in the U.S. has hit record levels in 2023, even though it's not a huge move higher in terms of the number of people. It says the lowest figure was in 2016 at 550,000, and now it's gone up to 653,000. So it added about 100,000 people. Raising rates had no positive impact on loosening the housing market in most regions. So again, higher rates can't slow the tightest housing market ever. A proportion of home inventory which is vacant for sale, which is literally nothing compared to history. So we've got the tightest housing market in terms of homeowner vacancy rates, but yet people think we're going to crash. Okay, good luck with that call. Whispers natural gas is a transitional fuel. You can see the light blue in the background there. Natural gas just ripping to the upside. Coal is definitely falling off of a cliff. This is the chart that I remember seeing when I put a lot of money in natural gas in 2020, and I was putting it in oil as well. But the transition fuel is definitely natural gas and coal. From my brother's also in the power generation world. He said we are replacing all of our coal power plants with natural gas. So I went long natural gas, and right now it is down quite a bit. Updating the S&P 500 bullish percent index, it's now at high overbought reading, and a decline back through 70 registers a sell signal. But not all overbought readings are created equal. In bull markets, stocks get overbought and stay overbought if a bull regime in a bull regime. So you can see that we are overbought. We're at 80.2. for the S&P 500, and these all marked short-term tops in the movement. But the one thing I will say is this: look at your lows. Your lows come down. It bottomed in October of 2022, and your lows have been stepping up, and your highs have also been stepping up. So you're in an uptrend. Says 2 continues, I expect that declines in this indicator and other breadth indicators will typically be more shallow, and I suspect that the associated market declines will be more characterized as healthy profit taking and rotation rather than outright broad-based selling. So we'll see how that works there. And then it says 3, like we saw in 2022 and 2023, while I don't remotely expect a Fed-fueled bull run like 08 to 21, the point is that you have to adjust your interpretation of overbought and oversold readings and the sell signals therefrom to reflect the major new trend. Okay. They have been ringing alarms for a while now. Is it different this time? And this is the leading indicators are ringing recession alarms. Now, here's the thing. If you look, these all bottomed in the rough area of where we're at today. What makes us think that this isn't a bottom? So recession means that you're actually moving lower. This is a recession, and that's what kicks off a recession, is the move lower. We've already moved lower, and it looks like it's bottoming and potentially ready to come back higher. So that means that the recession would be behind us. The way that I am viewing this chart, that's the way I view it. U.S. personal savings have nosedived to levels last seen just before the 2008 crash. But if you look at the early 90s too, this was all in a big decline, all the way to 2008, where the savings rate kicked back up. We had a savings rate kick back up in 2022. And usually, if you have a slowdown or recession, your savings rate goes up. And that's where the slowdown occurs, is when the savings go up. So I don't know how to necessarily read this chart. It's not predictive by any means. We went upward here, which also correlates with the slowdown here. But now we are coming back lower, which means that the recession already occurred, potentially. Again, that's the way that I view it. This is true wealth according to Nassim Taleb. So let's read some of these. Worryless sleeping, clear conscious, reciprocal gratitude, absence of envy, good appetite, muscle strength, physical energy, frequent laughs, no meals alone, no gym classes, some physical labor, good bowel movements, no meeting rooms, and periodic surprises. I would say I've got a lot of that. I would say pretty much all of it. I've got all 14. So yeah, I got the no meeting rooms that took care of. So yeah, I would say I got the majority of that, or if not all of them. Will U.S. production roll over when the lagged effect of lower completion activity kicks in? So this is your active frac spreads in the blue, and you can see that we've come down. And with the green, that's your lower 48 oil production coming on up. And this is where they changed the calculation and included natural gas liquids. So this also has a weird addition to it that's kicking the production up with natural gas liquids added back in. But here's your active frac quarter average. So we're coming on up till fourth quarter of 2022, 287, and now we're all the way down to 252. So we have had a pullback in our active frac quarter average. Gain of Trade says the probability of a recession in 2024 has now crossed 60%. This level has only been seen 3 times since 1960. All 3 instances ended in recessions. With heightened stock market volatility, today investors are convinced in a soft landing, yet the yield curve inversion strongly points to an incoming recession. This could catch a lot of investors off guard, but not you, because that's where we come in. Blah, 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 blah. There it is. Probability as of end of August 2023. You can see that we are way up and potentially coming down. Now, here's the thing. Remember what I talked about the savings rate? and some of these other leading indicators, and that they look like they have bottomed. What if the slowdown is already behind us and we're entering a new liquidity cycle, and that slowdown actually occurred already, and that this is going to come back down and cycle back down, and we'll get a new form of liquidity coming into the system? That is a possibility. Maybe it's already behind us. Maybe not. Maybe it's still ahead of us. But just wanted to bring that up. So that's what I've got for today, guys. We'll end it there. That's all we've got. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. If you're interested, I'm going to put up there the Thursday time for the training session that we're going to have on Thursday. It's probably going to be 8 a.m. Mountain Standard Time. So that's what I've got. And catch you guys later. This is Finding Value.